Okay, welcome to the Rules of Money. Today we will try to understand the credit card basics. Today's chapters. Chapter 1. Understanding credit cards and definition of terms. These innocent-looking plastic cards offer buying convenience, and when used wisely, they can even help you attain financial freedom. But be warned, when misused, credit cards may just end up strangling you financially. Keep watching and make your way towards financial enlightenment. Chapter 1. Understanding credit cards. At its core, a credit card allows you to buy now and pay later. Think of a credit card as a loan you have in your wallet or on your phone's app. When you use a credit card to buy, it's not your money you're using, it's the bank's. The bank agrees to pay for your purchases up front, but then they send you a bill for you to pay back the principal or the borrowed amount, typically on a monthly basis. And, if you don't pay it back in full, they charge you a fee called interest. Before we continue, I think it's best that we define key terms we will encounter in the credit card series. Definition of terms. Principal. The principal is the original amount that you borrowed on your credit card. Interest. Think of interest like the cost of borrowing the bank's money. This is the amount you pay the bank on top of the principal, also referred to as purchase APR. The monthly interest you pay is calculated as the APR in terms of percent divided by 12 for the number of months in a year, multiplied by the original amount borrowed or the principal. If you want to calculate your daily interest, this is the APR in percent divided by 365 for the number of days in a year, and multiplied by the principal. We'll get more into these calculations in another episode. APR, or annual percentage rate. The APR is the annual cost of borrowing on your credit card. A higher APR means that it would be an expensive debt, as you will pay more for the same amount of money borrowed. Comparing APRs is useful when applying for credit cards. As a rule of thumb, always go for the lowest APR credit card that you can get. Credit limit. The maximum agreed-upon amount the bank is willing to let you borrow on your credit card. This goes up with responsible borrowing and repayment. To an extent, you also have power to increase or decrease your credit limit according to your agreement with the bank. Okay, credit score. This is a three-figure number used by lenders such as banks to determine whether you are trustworthy or creditworthy. A lower score indicates poor creditworthiness, and you may have a hard time being approved for a credit card with low APR, since you are seen as a high-risk borrower. With a higher credit score, lenders may seek you out and offer you low APR credit cards, since they view you as a low-risk borrower. We will explore ways of increasing your credit score in a separate video. Minimum amount. This is the minimum amount you need to pay back each month so your credit card would remain in good standing. By paying the minimum amount, you will not incur any late fees, nor will you lapse on your payment. However, just paying the minimum amount every month will drastically increase the amount of time it will take to repay what you owe the bank. Okay, credit utilization ratio, CUR. Okay, credit utilization ratio, CUR. This is the percentage usage of your available credit. If you have a credit limit of $10,000 and you have a balance of $5,000, then your CUR is 50%. It is best to keep this ratio low, since this would signal to lenders that you are not overstretching your finances and you are using credit responsibly and not dependent on it to make ends meet. In this regard, a consistently low credit utilization ratio indicates high credit worthiness. Wrapping your head around these basics sets the stage for responsible usage of your credit card.